Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show as we continue with our franchising success series. And we've covered a lot of ground so far in the first 4 parts of this, but today we're going to talk about, more in depth the franchise business model. Now, if you missed any of our previous sessions, you can go to our podcast site and download those and take a listen to them. And these kind of really build upon each other. So I would highly recommend you go back and do that. Now, from a very, very basic standpoint, the business model works that, you've been enabled by this franchisor to operate a business. You pay a franchise fee and you get a format or system developed by the company and a right to use the franchisor's name for a specific number of years in assistance. And we've talked a little about the cost. We talked about the initial franchise fee and other expenses. We talked a little about the continuing royalty payments and advertising fees. But today what I want to talk about are some franchisor controls. And these are developed to ensure uniformity. They usually control how the franchisees conduct business. This is going to significantly restrict your ability to exercise your own business judgment. What am I saying here? The business model is going to be dictated to you from the franchisor because it's their license that you're basically agreeing to sell. So what does this look like in practice? How do they exercise that control? And there's a few things we want to mention here. Number one is site approval. Many franchisors retain the right to approve sites for their outlets and may not approve a site you select. Some franchisors conduct extensive site studies as part of their approval process, and a site they approve may be more likely to attract customers. As I mentioned before, they are going to dictate, in some cases, what the median family income needs to be. They're going to dictate, how many people need to live in a particular area where you're looking to open up your spot. So you need to understand that going into this, understand the franchise agreement. We'll talk a lot about that later, but how much control do you have over the location? You might say, listen, I live in Newark, Delaware, so I want to open up this restaurant in Newark, Delaware. And, you go gung-ho getting into this and they do the site survey and say, wait a minute, but this restaurant isn't going to be supported here. Maybe that's because there's too much competition. Maybe that's because the model doesn't work because of the demographics. Maybe it's too high of cost. The next thing you're going to talk about is design or appearance standards. Franchisors may impose design or appearance standards to ensure a uniform look among their outlets. Some franchisors require periodic renovations or design changes. Complying with these requirements may increase your cost. One of the ways we've seen this as of late is in the automotive industry. If you take a look at, if you go from state to state or town to town, you will notice that all of the Chevy dealers look the same, all the Ford dealers look the same, all the Mercedes dealers look the same, the Toyota dealers look the same. And that's because the franchisor in this case has said, if you want to sell our product, here's what your building needs to look like. Now, having worked with some of clients who have actually owned these type of franchises, this can be astronomically expensive. So you need to understand that going into it. Another one, we talked about this a little bit in one of our other sessions, is restriction on goods and services you sell. Franchisors may restrict the goods and services you sell. For example, if you own a restaurant franchise, you may not be able to make any changes to your menu. If you own an automobile transmission repair franchise, you may not be able to perform any other types of automotive work like brake or electrical system repairs. So you may be going into this, let's use the restaurant as an example. They give you a menu, but you find it, in our particular area, this particular item just doesn't sell. Well, I'd rather have this item. Let's talk about maybe Scrapple is one of those things. Some of the national franchise might not even understand what a Scrapple is. I love Scrapple personally, but they might not know what it is. But in your particular town, like Scrapple is like the thing that everybody eats for breakfast. But in this franchise agreement, you're not going to have the ability to make that change. Another key thing is restrictions on the method of operation. Franchisors may require that you operate in a particular way. They may dictate hours, pre-approve signs, employee uniforms and advertisements, or demand that you use certain accounting or bookkeeping procedures. In some cases, a franchise advertising cooperative may require you to sell some goods or service at specific discounted prices, which may affect your profits. Or the franchisor may require that you buy supplies only from an approved supplier, even if you can buy similar products or goods elsewhere for less. This is what I talk about when I talk about this national advertising. Let's say, national purchasing. So, let's say that you have a restaurant, you have a deal with Cisco is a big, restaurant provider to buy all of your food products from Cisco. But then, another local business comes up that you could buy those products from, and maybe it's cheaper. But see, the franchise agreement, because they've built this cooperative of all their locations, will not allow you to buy that from somewhere else. And that becomes a burden, because you may find that you can get that same product a lot cheaper from a local supplier as compared to buying it from the national supplier. But because of the fact that you're in this franchise agreement, you're not able to do that. They also can restrict your sales areas. They may limit your business to a specific location or sales territory, what they call exclusive or protected territory. In addition to that, you've got contractual obligations. Franchise contracts last only for a number of years as stated in the contract. You can lose the right to your franchise if you don't comply with the contract. You won't have a right to renew unless the franchisor gives you that right. A franchisor can end your franchise agreement for a variety of reasons, including your failure to pay royalties or abide by performance standards and sales restrictions. Many franchise contracts will give you a chance to cure an occasional failure to comply, like making one late payment, but to keep the right to terminate your franchise if you have other failures. If your franchise is terminated, you're likely to lose your entire investment. They're gonna rip the rug out from under you, and you may still have this building that you're leasing. You may still have equipment that you're making payments on. And in some cases, these franchise agreements may run for as long as 20 years, but renewals are not automatic. At the end of the contract term, the franchisor may decline to renew or may offer a renewal that doesn't have the same terms and conditions as your original contract. For example, the franchisor may raise the royalty payments, impose new design standards and sales restrictions, or reduce your territory. Any of these changes may result in higher costs, reduced profits, or more competition from company-owned outlets or other franchisees. And that's a big one. I had a friend that was involved in the cell phone business, and he actually had the particular brand name competing with him in his market because they were opening up company stores. So you would have his store selling the company's the company's product, and then right across the street would be the same product being sold by the company store. And guess who had the better deal? Well, of course, the company did. So you need to look at your franchise agreement and decide, is that going to be an issue? Are there restrictions against the company opening what I call company stores, in the same geographic location you're at? And what are the particulars of that particular franchise agreement? And that's why we're going to talk about that a little bit later in the series. Make sure you do your due diligence and understand what's in that agreement. Solicit the assistance of an accountant and an attorney to review that franchise agreement. Now, when we come back next time, we're going to talk about, is a franchise right for you?
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.